Are you like JCL? JCL's wondering why his portfolio isn't growing much, even though it feels like everything he's doing is well thought out. To make things worse, he's only 4% of the way to his investing goal, and that goal is a long way away. He needs to make decisions now to ensure he hits his long-term £1 million target. Will he carry on as he has been? Will he up his game and improve his investing approach? So in this video, I'm going to reveal a common mistake that I have made in my investing portfolio so that you can spot them and stop them happening in your portfolio. I'll also show you what happened next. So let's take a look at my portfolio from September 2021. So here's my US portfolio. Let's highlight 5 companies. Tokyo Education bought as a turnaround with a low price to earnings ratio. Tattooed Chef, it could be amazing in the future. It's actually not a profitable business at the moment, and management went on to disappoint. GAN, online gambling is going to grow in the US, and GAN is well placed to take advantage of that. It's the picks and shovels approach. They do the infrastructure for the sites. Seritage Growth Properties. There's some merit on that holding based on the valuation of their property assets and their development plans. And Voyager Digital, which is a really highly rated crypto platform that's growing rapidly with good reviews. So what happened next? So Tokyo Education, the stock overall was up just 3.8% a year in the market. I actually sold this stock and lost just £36 on it. Tattooed Chef, stock's down to 72% since September last year. Management continually disappointed. What's worse is I saw some warning flags and I didn't act on them. The Popular Investor made a video because he held Tattooed Chef that he sold it after we identified some red flags. I didn't, and I lost 59%. GAN's down 86% in a year. The market cap's just 103 million. I made an acquisition for more than that recently, and yet I still hold it. Seritage Growth Properties, the stock's down 20% across a year. It's been very volatile. The management changed, which was great, and they've moved their approach towards liquidating the assets, and this has helped the share price recover. So I actually managed to sell out at just a profit of £1. And then there's Voyager Digital. There's a crypto crash. They've gone bust. Thankfully, it was only a small position in my portfolio. But why did I buy it at all if this risk was possible? So these 5 stocks have been some of my worst positions. Some of these unproven stocks do the opposite of what's intended and kill your portfolio returns. So why is it that most portfolios fail to grow quickly enough? It's probably because you fail to take the initial steps, setting a portfolio plan and the rules. How do you want to structure your portfolio? What type of companies do you want in it? How many positions? And what sort of weightings? This is what I failed to do when I started. Now, I did do some really good things. I set up a budget. I paid myself first, a monthly minimum amount going into the portfolio, excess savings under budget into the portfolio. I have a target and a date by which to achieve that target, and I measure my success. These were great things. I suggest you do them as well. I didn't set up the rules for the structure and type of companies in my portfolio. Look what happened as a result. I ended up with TTCF, ended up with GAN. Now, of course, that's not to say that some people won't make money on these positions, but it's less likely because these aren't the top quality companies that have already won. It's less likely because success is far from guaranteed with these companies. So why take that risk? So meet Terry Smith. He runs the UK's largest fund, the Fundsmith Equity Fund. I've opened a position in this fund. Terry is going to help me up my investing game, and I hope he can help you as well. So Fundsmith has an annual meeting, and all these meetings provide great insight into Terry's investment approach and how he succeeds by investing in quality companies. So a great summary of all of this can be found in Terry Smith's book, Investing for Growth. It pulls all of these together. It's an absolutely great read. And the link for that book is in the description below. Please check it out if you want to learn how to make big returns consistently from high quality companies. So if I increase the amount of money invested into such high quality companies in my portfolio, I should do even better than I have been doing. With the high quality companies that I already hold, such as Berkshire Hathaway, American Express, they're actually compounding at 17.3% a year in my portfolio, which is great. If my whole portfolio, or a bigger proportion of my portfolio, was going in that way, my returns would be a lot better and I'd be closer to my long-term investing goal. So you don't want to miss out on this. Click here to see how my portfolio is evolving every month. Make sure you click to see how I'm implementing Terry's teachings. And this should help you get the results that you want.